Okay, let's dive into this. Welcome to The Explainer. Today, we're putting an incredibly fascinating company through what I like to call the gauntlet of gurus. As a focused learner, you already know that looking at a stock through just one single lens rarely gives you the whole picture. So today, we're going to act as expert investment analysts and run a complete top-to-bottom stock analysis on Progyny, ticker symbol PGNY. We're going to test this company against the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, run some modern quantitative models, and ultimately render a final verdict.
Here is the gauntlet we're running today. Company snapshot, the Buffett and Lynch lenses, the Graham lens, a DCF valuation, other valuation models, and finally, our synthesis and recommendation. Let's get right to it.
Section 1. Company Snapshot. So Progyny. They're a specialized benefits management company focusing on fertility, family building, and women's health. Looking at this recent Q1 data, the stock is trading right around $26.08. And in just 3 months, they pulled in $328.5 million in revenue, clearing $24.2 million in net income. But you know what's really wild here? These top and bottom line figures are staying super strong even after their absolute largest 2025 client fully rolled off. If you strip out that large client departure, their underlying revenue actually grew by an impressive 12.2% year over year. That is some serious resilience.
Now, what's really interesting about this slide is the profitability metric. CEO Pete Anevsky noted a strong start to the year, and while the numbers absolutely back him up, Progyny hit a multi-year high gross margin of 25.3%. They're doing this by dialing in operational efficiencies and keeping stock-based compensation lower. So we've got a growing, profitable company that's literally getting more efficient by the day. But how does it hold up against the greatest investors in history?
Section 2. The Buffett and Lynch lenses.
Let's start with the Oracle of Omaha. Warren Buffett looks for a few very specific things: an economic moat, consistent earnings, zero or at least manageable debt, honest management, and robust owner earnings. Honestly, Progyny passes this test with flying colors. They have a really clear first-mover network moat in specialized fertility benefits. Their balance sheet is, well, it's pristine. Literally zero debt and over $225 million in liquidity. On top of that, management is proving to be incredibly shareholder-friendly, recently executing an 8.8 million share buyback. And that true Buffett staple, cash generation, it's exceptional. They boast a 110% cash conversion rate from their adjusted EBITDA. Now, because Buffett usually demands a 20 to 25% margin of safety on intrinsic value, a likely buy trigger for him would probably sit right around $20 to $21 per share.
When we compare Buffett to the legendary Peter Lynch, it's a bit of a shift in perspective. Buffett focuses super heavily on those owner earnings, which, by the way, Progyny beautifully satisfies with over $500 million in operating cash flow generated just since 2023. Peter Lynch, on the other hand, he wants to categorize the company to really understand its growth trajectory. He places massive emphasis on a strong balance sheet, insider activity, and very specific growth ratios.
Applying Lynch's metrics directly, Progyny sits somewhere right between a stalwart and a fast grower. 12.2% underlying revenue growth is rock solid. The balance sheet, as we said, zero debt and massive cash reserves. Now, if we calculate their PEG ratio based on forward earnings, it does give us a slightly premium multiple, and institutional ownership remains high. Usually Lynch avoids high institutional ownership, but context matters here. The real kicker for Peter Lynch is insider activity. Management just authorized a massive $200 million corporate share buyback program. To a Lynch investor, seeing a company buy its own stock with cash generated from its own operations, that is a massive internal vote of confidence. Factoring in his growth at a reasonable price philosophy, Lynch's buy target likely hovers right around $24, so quite a bit closer to current levels.
Section 3. The Graham lens. All right, let's shift gears to Benjamin Graham, the absolute father of deep value investing. Before we even touch the math, we have to run his defensive investor checklist point by point. Adequate size? Yep. Strong financial condition? Yes. Remember, zero debt. Earnings stability? Yes. Dividend record? No. Actually, scratch that. They fail right away because they don't pay a dividend at all. Moderate PE and PB ratios? That's another fail at current multiples. But let's walk through his famous intrinsic value formula anyway, just to see. Step 1, we annualize their Q1 diluted earnings per share of 29 cents, which gives us roughly $1.16 for the year. Step 2, we calculate book value per share. So taking total equity of $439.3 million and dividing it by roughly 84.7 million diluted shares, we get about $5.18. Step 3, we plug this all into Graham's formula, which is the square root of 22.5 times EPS times book value per share. And here is the dramatic result. $11.62. That is Graham's intrinsic value for Progyny. With the stock currently trading over $26, there is absolutely zero margin of safety here for a deep value investor. Graham strictly requires buying below intrinsic value to protect against downside risk. Based on this very strict asset-heavy formula, Benjamin Graham would run far, far away from this stock. It's a clear avoid for the deep value purist.
Section 4. DCF Valuation.
Let's move to a more modern approach and see how this builds out. A discounted cash flow, or DCF model, basically forecasts the cash a company will generate in the future and discounts it back to today's dollars. Based on the sources, we're forecasting out 5 years. We base this on management's guided full-year adjusted EBITDA of $232 million to $244 million. Because of that stellar 110% cash conversion rate we talked about earlier, we can confidently project strong scaling free cash flows over this period. To fill in any gaps, we're assuming standard industry averages, modeling solid double-digit underlying growth as they continue to expand their client base.
But, a DCF is really only as good as its assumptions, right? So here on our sensitivity table, we're applying a standard healthcare tech weighted average cost of capital, or discount rate of 10%, alongside a pretty conservative perpetual terminal growth rate of 3%. Under these base case assumptions, our fair value per share lands right in the $26 to $28 range. So at a current price of $26.08, the market is pricing Progyny fairly accurately based on its expected cash flows. It's not some crazy deep discount, but you certainly aren't severely overpaying for their future cash either.
Section 5. Other valuation models.
It's always a smart idea to cross-check with additional models beyond just the DCF. First up, looking at a comparable company analysis using EV to EBITDA multiples, we can see 11 analysts polled by S&P Global leaning heavily on this metric. If we apply an industry average healthcare tech multiple to Progyny's projected EBITDA, it generates a fair value range between $26 and $31 with an average target of $29.73. That implies about a 14% upside from current levels. The market consensus clearly expects some multiple expansion here.
And this brilliantly illustrates why analysts are so optimistic. Progyny is actively expanding its core business directly to members, offering new support for pregnancy and postpartum, menopause, and parenting and child wellness. Wall Street justifies those higher EV to EBITDA multiples because the total addressable market is rapidly expanding within an already captive user base. As a second valuation check, if we run a reverse DCF model starting right at the current $26.08 stock price, it tells us the market is only pricing in about a 9% annual growth rate over the next 5 years. Given their historical underlying growth of over 12%, well, that reverse DCF actually suggests the stock is potentially undervalued right now.
Section 6. Synthesis and Recommendation.
So the crucial point here is blending all these insights together to see the whole board. Take a look at this summary. If you are a strict Benjamin Graham deep value investor, this is a clear sell or avoid. A fair value of $11.62 against a $26 price tag, that offers absolutely zero margin of safety. However, if you prioritize cash-generating moats, zero debt, massive buybacks, and steady growth, Progyny is a solid buy. Buffett's strict margin of safety would likely trigger a buy around $20 to $21, while Lynch, factoring in that growth and those huge repurchases, would probably step in around $24. Meanwhile, our DCF base case of $26 to $28 confirms the stock is currently trading right around fair value, and comparable EV to EBITDA models project a fair value up to $31.
Ultimately, this stock offers tremendous operational strength, but it does lack an asset-based safety net. It really comes down to what kind of investor you are. So I'll leave you with this final provocative thought as we wrap up this explainer. Knowing that value is truly in the eye of the framework you choose, at what price does PGNY become an undeniable buy for your portfolio? Think about your own margin of safety. Thanks for diving into this with me today, and keep testing those frameworks.